Welcome to this month's Economic Update. I'm Sinead, Rafferty, Portfolio Specialist at MLC, and I'm joined by our Senior Economist, Bob Cunneen. Welcome, Bob.
Hello, Sinead.
Bob, it's been a poor month for global share markets in August. What was behind the rise in volatility that we saw?
Primarily, it relates to the trade war between America and China. So what you saw at the start of the month, President Trump announced a 10% tariff on $300 billion in Chinese imports. This trade war escalated so that on August the 23rd, President Trump raised that 10% tariff to 15%, but also raised the pre-existing tariffs from 25% to 30%. So this trade war has escalated and intensified, and that was the primary reason why global share markets fell 2% in August.
What about in Europe? We're seeing a lot of headwinds on the back of the slowdown that we're seeing in Germany, and also what's going on with Brexit, or what's not going on with Brexit. So where to from here in terms of monetary policy in Europe?
Yes, so Europe is particularly weak. So if we looked at the June quarter economic activity data as measured by GDP, you saw both Britain and Germany's economies contract in that quarter. And that's a combination of the trade concerns, but also Brexit. And because of this, the European Central Bank has in recent commentary indicated that they're prepared to lower interest rates and potentially restart their asset purchase program, also known as quantitative easing. So we have a weak European economy that needs more stimulus to get back to their growth and inflation targets.
What about the gold price? We've seen it reach levels that we haven't seen since 2013. Is there a sign that investors are getting nervous about markets?
It is a sign that they are concerned about political risks. So a combination of the trade war, the Brexit issue, Hong Kong tensions, Iran, North Korea. So the gold price is seen as a safe haven. And in this political risk environment, which is quite high, gold is seen as a good defensive asset. Against that is the fact it's also a low yielding or zero yielding asset, so you can't really generate an income stream from gold. So you need to be careful that it's not a sustainable long-term investment if you're looking for yield. It's more of a defensive play.
What about the Australian share market? It was down 3% in August after such strong performance that we'd seen earlier in the year. What was the reason behind that?
Primarily it relates to the trade war issue and the weakness in global shares, but it also reflects concerns about Chinese economy in terms of demand for our raw materials. What was quite noticeable is that the iron ore price went from $115 per tonne down to $85 per tonne. So that saw a very sharp fall in our resources sector, nearly 8% for August itself. So those China slowdown concerns are quite significant.
Is the market pricing in further rate cuts here in Australia?
Yes, they are. So we had an interest rate cut in June and July by the Reserve Bank, getting the cash rate down to 1%. And the market expects that the end point for cash rates will be closer to 0.5%. So 2 further 0.25% interest rate cuts are expected.
Thanks for your time, Bob.
Thank you very much, Sinead.
And thank you for joining us.